Hello and welcome to Tête-a-Tech. For those of you joining us for the first time, from day one, our mission at Bay Brazil has been to connect tech players from Brazil and Silicon Valley and promote dialogue, opportunities, and knowledge sharing. With the shelter in place and social distancing, our events are on a halt right now. So this dialogue is becoming more prevalent and we are doing this weekly. So thanks for joining us today. So our guest today is a very prominent investor, Hans Tung, partner at GGV Capital. Our board member, Andy Sao, Managing Director of Silicon Valley Bank, will moderate this chat, and you can participate by sending us your questions, and we'll fill and through the chat. Okay, Andy, welcome, and welcome, Hans. It's very good to see you and very good to have you in this chat.
Thank you, Marguerite. Thank you, Andy.
Obrigado, Marguerite. Thank you for coming along, Hans. Again, my name is Andy Tsao, and I'm a managing director at Silicon Valley Bank and head of our Global Gateway, which is a business development team that's focused on major tech hubs outside the US, including Latin America, India, and Australia and New Zealand. As Marguerite mentioned, I've also been on the Bay Brazil Advisory Board for the last 6+ years. And though I'm not originally from Brazil, I'm what Marguerite refers to as a Bay Brazilian. So thanks everyone for joining us today in our Bay Brazil Tête-a-Tech, where we'll be spending some time with none other than Hans Tung, managing partner at GGV Capital and perennial Midas list venture capitalist. Hans and GGV are investing globally and have been in so many amazing companies in the US, China, India, Southeast Asia, and of course, Latin America. They've been in companies such as Airbnb, Slack, Peloton, Xiaomi, to name a few. We've been fortunate at Silicon Valley Bank to work closely with Hans and GGV for many years. We're going to speak to Hans today about his perspectives on the current crisis due to the pandemic. So Hans, again, thanks for spending time with us today. And how are you personally doing with the shelter-in-place restrictions? I know you have a young family at home.
Right. I used to travel over 300,000 miles a year. Now I haven't gone anywhere in the last almost 2 months now. So it's the longest quote-unquote break that I ever had by staying in one place. So that part, my wife's happier. We have a young kid, like you mentioned. We have 2 kids. Our second is only in 2nd grade. So he needs a lot of help staying in front of a computer, staying in front of Zoom during the school hours, because there's a distance learning going on. And my wife has to spend like time sitting next to him from 9 a.m. to 2 p.m. So that's driving her nuts. For the most part, we enjoy being able to take a walk at the end of the day around 5 or 6 o'clock around the neighborhood. So that has been good. But we know that a lot of people around the world are impacted by this. We have 30 investments in New York alone, and 3 companies have a co-founder who actually got the virus and went through it, survived, but it was a hellish 2 experience for all 3 of them. Wow. So our hearts go out to anyone who's affected by this. We also played a small part and donated money to charities, especially helping the healthcare workers, saving lives on the front line. We did that in New York, Boston, New Jersey, Detroit, Seattle, New Orleans, and the San Francisco Bay Area. So in addition, we donated to people, to charities in Hebei in China, as well as in Indonesia and India. And we'll do something for Brazil as well.
Fantastic. I know the sort of the health and human toll of this particular crisis is different from anything we've really experienced in the past. So that's great that GGV is doing those kind of things. I guess, now that we're into the pandemic. So what's your view on the impact of the pandemic on the innovation economy in particular? And I know you're in constant communication with your portfolio companies now. What are the, kind of, if you had to give sort of top 3 pieces of advice, what would they be?
Right. Top 3 advice, well, yeah, it would be cash flow, growth, and employees. And the reason I say that is that, we have about 200 active portfolio companies, of which now 80 to 85% of that 200 have cash runway of 12 months or more. Most of that 165 companies have cash runway for more than 2 years. Then the next group of roughly 10-15% of that 200 have cash runway about 9 to 12 months and extending that into 12 months as we speak. We do have about 10, 12 companies among 6 partners that seriously needs help. So we're spending time helping those 12 make sure that they can get the support they need. And we saw this movie played out unfortunately, in China first, where we have a substantial of our 200 investments are in China, roughly 45%. And as this is happening throughout Chinese New Year in late January, February, first half of March, you see how companies come together and learn from each other. We hosted about 14 webinars in the span of 3 weeks, just get a portfolio company to share. And we invite speakers from outside, including the former CEO of Alibaba in Chinese to share knowledge. And so that was super helpful to the portfolio company to learn about cash flow management. And then over the next 1 year, next 4 weeks, 1 month, we end up sharing that knowledge in English now with portfolio companies and founders in the US, Brazil, Southeast Asia, and India. So cash flow, that's the first thing. Second thing is that even in this time, there's still growth opportunities. You look at education, you look at digital health, you look at even e-commerce. There are things that are growing right now. So how do you take the company and figuring out what are the things you can do to serve your consumers or enterprise customer better during COVID-19 is super important. And then thirdly is employees. One of the key things we learned from our Alibaba experience back in 2003, as soon as we made that investment, SARS broke out. And then for the next 9 months, things were looking not so good. But that's when Alibaba launched Taobao, their first C2C initiative. And from that, they started to grow even more than what they did before. And one of the things that they did, even before SARS hit, was get employees ready to be able to work and make decisions on their own, to take more actions, take more initiative, be able to make decisions based on company mission and vision and values, so they know how to do the right things. And so none of them anticipated that they had to work from home during SARS in 2003, but when they did, all the employees knew how to make decisions, do what's best for the company, and launch Taobao while all that was going on. So it just shows you that you have a motivated employee workforce. It could help you to grow even during a period like this.
Yeah, Hans, on that point, it's obviously a probably a good time to be focused on product development right now. Given how uncertain customer behavior might be out there. But as you look at companies who might think of pivoting into areas where there might be some traction right now, versus kind of doubling down on your core proposition. How do you look at that? Do you pivot, or do you kind of stay the course?
Right. I think it really depends on how the business today is positioned towards the COVID-19 and your outlook on how long this will last. If you look at what happened in 2003 with SARS, and then at a different level, 2001 when the first internet bubble, and coming to the end in 2008 with the financial crisis, each of these things last somewhere between 9 months to 2 years. So we could be stuck with this for a while, and this is more contagious, and it makes greater impact than almost anything we have seen before in our lifetime. And so, unless there's a lot of tracing and there's a lot of development on vaccine that can come out sooner rather than later, we could be with practicing social distancing for a while. And there's increasing risk that a second outbreak during the flu season in October, winter this year could make this much worse. To have a second outbreak worse than the first outbreak. So if you take that as a new normal, based on any study you look at, for what is from Dr. Fauci in DC or the Stanford study, it is going to be with them a while. So you got to figure out how to grow during this time period. If you accept that as the precondition, then you should figure out what does your customers need. We have a number of food distribution companies, for example. They used to supply to restaurants. So restaurants are mostly closed, but grocery stores, supermarkets are open. So can you distribute to them and do that more? You used to do B2B. Are there ways to do B2C to reach out to the consumers as well? Because many people do need groceries and food supplies today. So are you willing to be creative, not just start doing one thing and do more where the demand is shifting to? That's going to determine whether you should be growing during this time period or just try to stay afloat and get through this period.
Right. And it just, I guess, trying to pin you down a little bit on the sort of the amount of cash you should have today. I think you're saying, kind of 12 to 18 months would be great. And obviously the more, the better, but I've heard as much as, 36 months worth of cash. What do you think is?
There's some firms out there in the Convictions and Squares of the world are saying that you should have 3 years. I think that's extremely optimistic. It's too late to have that kind of cash runway. But you need to have at least 12 months to get through to end of Q2 next year. Obviously, 18 months will be better. And we encourage company any way possible, if you can grow during this time period, and you make sure your burn is cut to, you have 12 to 18 months. Then with the growth that you have, you may get to 24 months. That somehow can make the math work. And it is never easy to reduce your burn, especially in a moment like this when everybody is negatively impacted. Alibaba at one point in 2001, early 2001, they had only $10 million of cash on the balance sheet, and the burn was $2 million a month. So literally, even as somebody as big as Alibaba in 2001, they only had 5 months of cash runway, and they had to change that very quickly, reduce the burn from 2 million to less than 1 million, give them extra 10 months, and then find a new business model that made Alibaba.com work. So the Alibaba that we know today did not exist back in early 2001.
Yeah, it's again the old adage that some of the greatest companies were built during some challenging times, and that's certainly true for all. That's a good segue into sort of your view on the China market right now. I guess looking at China pre-COVID, China was already kind of, the venture market anyway, was kind of contracting, I think, with the trade frictions with the U.S., et cetera. And obviously when it went into the pandemic, then it contracted further. But can you give us your thoughts in terms of kind of what was happening with the venture market pre-COVID, how China reacted during COVID, and now we have the benefit of, as China begins to emerge out of COVID, are there things that we can learn from China as it reemerges? And how do you see kind of China venture market as we go into the rest of this year and next year?
Sure. What I noticed over the last couple of years, and definitely the monasteries in Sao Paulo, noticed it since 2015, 2016, is that there are a lot of lessons from the Chinese internet market. That's a great model to look at in addition to the US model for Brazil and emerging markets in general, because China had gone through so much urbanization in such a short period of time. And internet penetration, whether it's initially on the PC desktop and then with smartphone, just grew so rapidly that you have unicorns, about 120 plus unicorns being born in the last 10 years. And so just the amount of growth that happened was almost unparalleled. And so it becomes very interesting to study their model to figure out how to go after the mass market, serve the mass market to build a massive company. And then the concept of super app came out of China with WeChat, with Alipay, with Meituan Dianping, and so forth, some of which we're investors in. So China has become an interesting model for all of us to study. I was on the ground. I moved from Silicon Valley to China in 2005, and I was on the ground for 13 years, and then moved back to the Bay Area in 2013, but still go there probably 5 times a year. So going back and forth and making actually now most of my investments in US and Latin India, I still do some investments in China. So that's the backdrop. And what I've seen over the last 10 years is that China definitely grew a lot with the dividends of the smartphone penetration. But right about a couple of years ago, that growth slowed down, partially because anybody who has a smartphone by now. And so the additional growth from new users is a lot less. What is happening in China is that all the growth from the consumer side has shifted to leveraging smartphone to make the offline economy, the B2B businesses, vertical by vertical, become more efficient. That is, in China, they call it Internet Plus strategy, and Internet Plus real estate, Internet Plus retail, Internet Plus media, Internet Plus construction, et cetera, et cetera. And that is happening, but it's at a slower pace than the consumer growth you see with smartphone and application that you can build on top of that for the last 10 years. So there's a shift. So you see investment slow down. That's the primary reason. But it doesn't change the fact that when you see ByteDance gets born and TikTok's doing well, and TikTok now has e-commerce in addition to short streaming video, you still see quite a bit of innovation on the consumer side. You see a lot with supermarkets that Alibaba wrote out called a Heba store, that every product has a QR code. So you go inside, you scan it, you know exactly where the product comes from, and then they can deliver to your home within the next hour. You don't even have to take the stuff you buy with you out of the store. So you do see quite a bit of innovation by big companies in the consumer space, more and more out of China, and that's just interesting. There's just another set of data points to look at.
Yeah. Hans, do you think as China is emerging out of the pandemic, do you think the venture market's going to rebound quickly, or is it going to take some time in China?
We are in 2 deals in China, led by 2 different colleagues. Both of them are round size, over $100 million, and both are oversubscribed. So you're seeing the Chinese VCs are back in the game investing, but at the same time, the growth prospect of those companies are not the same what it was 5 years ago, when it's all consumer. Now it's more B2B or B2B2C. So growth is slower, but still, in the sort of 70 to 100% year-on-year growth rate versus like 200% to 300% year-on-year before.
It's all relative, right?
It's all relative. Yeah.
So how do you contrast that then to obviously GGV invests in US as well? So kind of where do you put the US in your basket of countries these days?
I think in general for US, we're seeing growth happening a lot on the enterprise side. During COVID-19, it becomes very obvious that everybody working from home more and more, and the access points to everything will move to the cloud for sure. The process has speed up a lot, and then cybersecurity plays an increasingly important role because now you have multiple access points to that server in the cloud. So the amount of innovation that's happening on the enterprise side in the US is impeccable. And over the last 3 years, you see roughly about 6 to 10 enterprise IPOs a year. So over the last 3 years, you have roughly 20, 30 enterprise companies now valuing at about 3 to 5 billion market cap. And they have a chance, some of them, the ones from Bash 2017, has gone up to like Datadog, have gone up to over 10 B in market cap. So you definitely see that happening in the US. At the same time, you also see that there's still growth in the consumer space, but increasing more B2B2C model. For example, Shopify has done extremely well based out of Canada, but US is a very, very big market, and also Asia is increasingly a big market. Shopify continues to grow as a publicly traded company. When they were listed for IPO 5 to 6 years ago, I think the market cap was in single-digit billion. Today is $45, $50 billion market cap. So you do see B2B2C happening, enabling a lot of merchants to be able to sell online more efficiently, and they all need different kinds of IT solutions. So SMB tech, as a result, has become a very sizable market to invest, and a lot of solutions selling to that has some kind of e-commerce angle to it. So leverage what we have seen work in the e-commerce space, but at the same time, the growth is primarily to SMBs.
Great. So obviously still lots of opportunities in the two biggest venture markets, and GGV's roots were kind of U.S. and China investment, but you really over the last couple of years, broadened your geographic scope quite a bit. We talked about Brazil and India, and you actually have offices now in Singapore to invest in Southeast Asia. So, what was kind of the investment thesis behind that?
Right. It's all this builds into what we said earlier. If China was slowing down because growth is not coming from the consumer side as much, it's shifting to more of the enterprise side, then all the knowledge we picked up on the consumer side, we want to figure out what are the next great emerging market where that knowledge could be put into use with the local founders and local VCs. And so working with the Monashis and Kazakhs in Latin, and then GGV actually started off in Singapore and Silicon Valley from day one back in 2000. So we just literally reopened our Singapore office last year. But we've been doing investments in Southeast Asia for the last 10 plus years. And we see Grab doing extremely well in Southeast Asia, a company that my partner Jishun that is Series B in. And then India, obviously, given the size of the market, even though it's not just one market, it's multiple markets combined into one, but there's quite a bit of interesting growth ahead. So these are three big markets that we either have prior experience in or geographically easier to get to on a relative basis, that we end up looking at all three regions and doing more, especially in Southeast Asia. And I think with Latin in India, they're both relatively new markets for them, that we have about 3 fund investments in Latin, and personally I'm in another 10 investments in Latin. A lot of them working with Monashis. And then in India, we have 4 investments in the last 9 months. So we have been quite active in these new markets.
Fantastic. I think you and GGV refer to it as the next billion. It's sort of you've kind of got the first billion covered. Now you're looking for the next billion.
Right.
So on that front, I know speaking of Latin America, it 2019. I think the LAVCA numbers came out just recently, or they at least announced the total funding for 2019 which was 4.6 billion.
Yep.
More than 2x of last year. So they were on a real roll. But how do you see now 2020 playing out in light of the pandemic and sort of the medium term future of innovation in Latin America?
I think there will continue to be more of an innovation coming out of LATAM for sure. I think whoever invests in LATAM just need to be more patient. It takes a while to scale a business, and during that time, there are going to be fluctuations with the economy. There will be fluctuations with currency exchange rate. So one has to just be more patient and be able to wait it out. We are more willing to invest earlier in the stage and grow with the company, but selectively we may end up investing in some of the later stage ones as appropriate. But our preference is still investing early and grow with the company, because over time those short-term disruptions tend to get weighted out in the long term, but not matter as much. If you look at LATAM, it is a market with enough user base of over 600 million, and then you have a GDP per capita on average is higher than most of the other emerging markets around the world, at about $7,000 to $9,000 US dollars per capita, versus India, which is less than 2,000, versus Indonesia, which is about 3,000. And so there's definitely enough critical mass in 2 primary languages that it is actually very good market to build companies. The challenge is have the founders be fast on learning from other markets and pick up things and grow accordingly. How to train up talent, how to have access to engineers to build. One comparison, each year in China, number of STEM graduates out of colleges, science, technology, engineering, and math, is roughly 4.3 million. In India, it's 2.6 million. And in LATAM, it's a lot less. It's less than 300,000. So when you need engineers to be able to grow. And so having more access to the tech talent pool in order to help more companies get started is increasingly important. And I think that it's not impossible to leverage talent from elsewhere to help LATAM to grow. One of our good friends from Southeast Asia is a Stanford GSB alum, and he founded the company CSE, and it has two businesses: Garena, which is gaming, and then Shopee, which is in e-commerce, both in Southeast Asia. But for Garena, which is a mobile gaming company, LATAM is actually the fastest growing market for him. When we first met him in 2015, when Tencent invested, his market cap in the private market was like 2 billion. When he first listed IPO a few years ago, market cap was 4 billion. If you check the market cap today, it is now 35 billion. And a lot of growth is happening due to Southeast Asia and LATAM.
Absolutely. Yeah, I guess one thing I take encouragement from or inspiration anyway is you look at Brazil and the crisis that they went through only a few years ago with a political crisis and a terrible economic recession, and yet there are many companies that you and I know today in Brazil that have gotten to unicorn status and so on. So I think perhaps now, if history repeats itself, whether it's in Brazil or in general, as we've discussed about great companies being built during challenging times, this might be another one of those moments.
Completely agree.
So I guess, Hans, what would your perspective be as we look at this notion of developing markets versus emerging markets in this kind of risk environment? Do you think, whether it's from a GGV view or as you interact with other international investors who did so much last year in terms of funding Latin American companies, particularly at the growth stage, do you think there'll be more of a sort of a de-risking and investors looking more at U.S. and more established markets, or do you think there's going to still be appetite to invest in Brazil and Latin American companies?
I think that short term, there's a challenge in which there will be companies in the U.S. and China that may be investable at a lower price than otherwise because of COVID-19. And it is still, the amount of money in these markets is still great enough that those deals may get done first. And funds that we're looking at, LATAM, may be more quote unquote distracted with the kind of opportunities they see in the home market. So I think the number of deals at the growth stage may come down a bit, but the amount of money put to work, I think, will still be meaningful because the better companies, the best companies, can still get funded. But the ones that are maybe on the borderline a bit earlier or still needs more time to prove its business model may take more time to fundraise. And we saw that happen in China 10, 13 years ago when we was going through a 2008 financial crisis as well. So it does happen for an emerging market that's earlier in stage of development.
That might lead to some consolidation opportunities, do you think?
Yes, I got calls from Goldman, from Morgan Stanley, from Bank of America, from Deutsche Bank in the last 2 weeks, all offering help that, hey, if the IPO market is not happening, what can we do with the portfolio to facilitate any industry consolidation? So there will be more of that happening around the world.
Makes sense. And I guess getting a little more tactical now in terms of entrepreneurs who are out there trying to fundraise, whether it's in Latin America or other markets, is it possible right now for entrepreneurs to fundraise? Are you doing new deals right now, and maybe digging into if you can get the attention of GGV, how should entrepreneurs be thinking about deal terms? Yeah,
on the new investment front in the U.S. over the last month, we ended up investing 3 investments by 3 partners. And we also had another 3 follow-ons that were participated. So I think that there's still a healthy level of activity still. I think a lot of based on the health of the fund. If your portfolio companies have less issues, you have more time to look at new investments, or you should close a new fund, then you have fresh capital you can put to work. Having said that, we do see that valuation vary. The ones that are doing well now during COVID-19 will have similar kind of valuation to before. The ones that are desperate for money, they still get a deal done, but at more repressed terms for sure. If you look at what happened to, for example, the SaaS market over the last 6-7 years, in 2014, there was a SaaS adjustment, and next 12 months, revenue multiple compressed from 10x to 5x. In 2016, there was another adjustment, and next 12 months, revenue multiple for SaaS went from 7x to 4x. And then in 2019, there were a couple bumps, and also see compression from 15x to 9x for next 12 months revenue multiple. But you can tell, even though there's 3 sample points, each time the revenue multiple went higher, even when they get adjusted downward, was higher than the low point one before. So you look at the e-commerce revenue multiple, it was about pre-COVID-19 was about 4x. During in China in February, and in the US in March, it went down to 2-3x, more 2x revenue multiples. So it got cut half. But now you look at all the e-commerce players, publicly traded ones, they're all doing very well. And revenue multiple has come back. And I didn't anticipate it come back in only 1 month, but it did, because people are buying. Why is that? It's counterintuitive. But if you look at it, 90% of the retail in the US is offline. If offline stores are mostly closed, then where do people do shopping? They would do it online. They may not buy apparel, but they were buying home products because they're stuck at home more. They will buy products for equipment. They will buy stuff for outdoor. They will buy stuff to make the house prettier. They will buy exercise equipment like jump rope for kids. So people were still buying. They're just not buying from offline. They're buying online. So we actually see that there's a push towards digitalization across the board in many markets, especially outside of China. Because China e-commerce already 20% of retail is e-commerce. Everywhere else is 10% or less. So this offline push actually makes digitalization happen at an even more rapid pace. If you look at communication, who doesn't use Zoom these days? If not, you'll be using Slack. You'll be using WhatsApp. So the kind of move to digital is unparalleled. And actually, in hindsight, COVID-19 could be a key growth driver for online education. It could be a key growth driver for digital health.
Yeah, absolutely. Those are some sectors that should do well despite the pandemic. I guess looking at the other side of that coin, you know, as consumer behavior kind of changes because of the pandemic, I'm thinking of certain models that may face new challenges. For example, in Brazil last year, or Latin America, you had a number of Proptech companies that raised a lot of money with a lot of promise in Brazil, but the dynamic has changed because, you know, real estate in this market is a lot different. And I think of Airbnb, a company you're directly involved with. I know I'm going to think a little bit differently next time I want to go on vacation. I look forward to the day I can go on vacation again. But you know, will that house or will that room be clean enough for me not to worry about it?
Yeah, I think with Proptech, I'm a personal investor in a couple of them in Latin, and we're investing in Open Door. So you do see that home ownership is shifting now to rental more. So people will still be buying homes, but now most of the cities cannot verify your purchase and give you a deed. So there's definitely a slowdown, but if they have raised enough cash, they should really trim down the burn and just kind of wait it out. And it's actually a great time to be great as a relative term, of course, to develop a product better, to become more efficient, and tune the operation more. So it is not as happening, but there's more work to be done to make it better. For travel definitely is affected for sure. And for Airbnb, initially was like, oh my God, what does this mean? But having $2 billion of cash injected via debt helps solve some of those issues. And the early signals from China post the first wave of COVID-19 is actually very encouraging. So you do see a pickup happening in China. And more importantly, even in other markets, you're seeing that people taking staycation, short-term, from short-term rental to medium-term rental, where they can stay in a place for 2 weeks or more. And you also see that a shift towards long-term rental, more than a month, is happening on Airbnb as well. So I think that by having a marketplace model where you can shift the supply and demand to a category that could still grow makes sense. So I think Airbnb will look differently during this time period, but it will still be able to grow because of the network, the infrastructure that built.
Well, that's a great example of a company that's super valuable and will continue to be in the future. Are there, as I wrap up my questions, and we'll turn to some of the questions that were submitted. Do you have another example or two in any of the geographies you're investing in terms of companies you're really excited about in the GGV portfolio despite the pandemic?
Sure. We're an investor in a company called Chief in New York. You can think of as a YPO online for women, especially women officers who are VPs and above, mostly founders or C-level officers. And the model was membership based. It was offline club membership, and then 8 to 10 of them gets grouped together, and somebody leads discussion so they can talk about things that they're seeing in their career and life that they want answers to, and get help from support from the rest of everyone else in the group to further advance their career interest. And we encourage them to move to digital as when we first met them in 2019. As soon as COVID-19 hits, they start moving everything online, starting with Zoom first. And now they continue to grow during this time period, helping a lot of women leaders starting off in the New York area to deal with what's happening. And they're getting a lot of inbound interest from other cities that are on their the timeline to expand to. And as an investor in Peloton, we clearly see how Peloton's growing during this time period. Peloton Digital, even without the machine, is growing fast. So you know that online experience is here to stay. Online sharing is here to stay. Online webinars, conferences are here to stay. Online networking is here to stay. So there's going to be so much more things that can be done. Again, I don't want to sound too optimistic because I know that there's so many people who are negatively impacted by this. So it's important that even with all the turmoil that's going on, to figure out how to take care of your employees. That's your biggest asset, and to empower them, align them, and work out new business model if possible during this time period, and figure out a way to grow. It is not easy. I was a founder once. I know it's much easier to give advice to actually make it happen. When I was a founder, I hated when VC give smart comments, one comment, two comment, think that once said, the world has changed. It does not. I think a VC takes himself too seriously. It is a lot harder to make something happen. And so all the credit and best wishes go to the founders for going through the spirit.
And on that front, Hans, as a follow-up, as far as leadership goes, and I know you referenced the interview with Savio and Alibaba that you guys did in some of the decisions that they made during that difficult time. What advice would you give to founders or CEOs today in terms of leadership as they go through this crisis?
Yeah, I think one thing that I learned is that especially during my VC career, is that the best founders learn from other people's experiences, and they don't have to do everything themselves first in order to learn from it. A lot of smart people tend to say, well, I'll be different, and so rather learn from their own experiences. To the extent possible, if they get better from other people's mistakes and not have to repeat them on their own, that will be extremely important. Jack was willing to recruit people from finance Joe Tai, from GE, Savio Kwan, and from a variety of different walks of life, to assemble a team that grew and gelled together between 2001 and 2003, not made it possible for them to overachieve since. A lot of people don't know this, but the market cap of Alibaba today is $500 billion. The business that they were in 4 years into their operation, 2001, did not exist after 2002. The business that Savio helped to start between 2001 and 2003, called Alibaba.com, which is a B2B listing business, that's worth less than 5% of market cap today. Most of the growth happened post-SARS, post-2003. So no matter how bad it is now, still have the hope that tomorrow, next year, could be dramatically different.
Terrific. A great way to end our chat. But I'm going to go, Hans, to some of the questions that were submitted. And let's see. Okay, this is a slightly different twist on a question we've already talked about a little bit. How do you see US VCs investing in Brazilian startups at the Series A round? So this would be an earlier stage. We talked a little bit about growth stage, but do you think US and international VCs would be still investing in earlier stage Series A investments in Brazil?
I think that there will still be, the Fifth Wall of the world, DST of the world, ourselves, we may still participate. But I think most of the international money still will come in Series B and later. That just given COVID-19 and the impossible to travel, that later stage or growth stage makes more sense for most international funds.
Is there, Hans, are there any characteristics you might look for at an earlier stage that would pique your interest in terms of investment?
For early stage, for us, is usually 3 criteria. One, it's the amazing founder and team that learns extremely quickly and efficiently. 2, the market and the angle they have in mind makes a lot of sense domestically or at least regionally. And then 3, that there's some early signals or proof points that show that this team not only has great vision or a great team on paper, but knows how to execute and start small and make things grow.
Great. Okay, another question. We've seen several EdTech online tutoring unicorns in China and India. Do you think Latin America is ready for an EdTech unicorn, and why?
If there is one, it has to be someone that's in both Brazil and ideally Mexico. You got to be some of the bigger countries and build a pan regional presence. So definitely it is possible. It takes quite a bit of work to get there.
Oh, I think we lost Andy, Hans.
Yeah, it seems.
Yes, we lost Andy, but I do have a question for you.
Okay, go ahead, Marguerite.
With what's going on right now, shelter in place, social distance, a lot of people working from home, actually most people working from home, right? Who are not doing essential services. How do you think this experience will change work in the future?
Yeah, for sure. That's a question that all of us spend time thinking about. There's no question people will be working from home more. Before, if you dial in via Zoom, people think that you're not working hard enough. You didn't bother to travel to where you need to go for the board meetings or spend time with the management team. But these days, everybody's leveraging Zoom, and so there's no question that you need to companies to figure out a way to make it helpful to employees to be able to work from home. Look at the Zoom stock; it's gone up dramatically since beginning of this year. There were about 20 million people using Zoom a day at the end of last year. Actually, only 10 million, and now it's 200 million. So it's growth of over 20x in the span of 1 quarter. And so they're going to be. You see a lot more virtual hours. You see a lot more coffee breaks online. People do that virtually with each other. So there's no question that working from home is here to stay. And every company needs to figure out a way to accommodate that and be able to have the IT infrastructure that deals with that. So there's going to be a lot more investment opportunities around enterprise space that enable cloud infrastructure solutions, and also have cybersecurity solutions that can manage that much better. Because not as many people be in the headquarter office in one physical space. And you're also going to probably see less demand for open space office space. Those kind of environment makes it easier for virus to get spread. So a lot of things that we do will be quite different as a result of this.
Yes, and I see that Andy is back now.
Yeah, sorry about that. I think my internet got a little wonky there, but yeah, it's funny as you think of open plan space, and the bank we went through just the last couple of years, sort of moving towards open space, and now, as you say, Hans, it may be we may look at it differently as we go back to work. But
yes.
That covers about the question. The other questions are repetitive to what we've already covered. So, Marguerite, anything else on your side?
No, I think this is great. Thank you so much, Hans. If I could ask just one more question about early stage, the very early stage companies. We have a lot of Bay Brazilians working here in the region and elsewhere who are really struggling right now, right? They don't have that cushion to keep their companies going. Can you give them an advice on how to navigate this crisis and move forward?
Yeah, I think for those that struggle to raise money, it's not a bad thing to think about, and I don't mean being pessimistic. It's not a bad thing to think about if the company's still very, very early stage. Go join another startup and work there for a few years, especially those that are growing during the COVID-19 period. If this thing will last for 2 years, your opportunity cost is actually quite valuable. So spend the next 2 years wisely so that you can benefit from this in your career. So I think the founders that's in very early stage who haven't raised a lot of money should think hard about, do I want to spend the time, spin the wheel for another 2 years, or join someone who's growing during this time period so I can get a leg up afterwards and gain more experience. My advice to a lot of first-time founders is that don't be. If you can, spend time in another venture-backed company that's growing fast and help them to scale and leverage their platform and pick up more experience. So by the time you're going to do it yourself, 2-3 years later, you're even more ready.
Well, that's great advice, Hans. And I think as you said earlier during our discussion, that one way that we can all get through this crisis is sharing information, and certainly webinars like this and your great advice here is going to be helpful for those entrepreneurs out there. So thank you so much, Hans, for sharing your thoughts. And Marguerite, turn it back to you.
Thank you both. Thank you, Andy, for moderating. Thank you, Hans. Obrigada. And for those of you joining us, thank you so much for participating. Thank you for sending questions. This coming Friday, we will have Emanuel Lemos from Ready Point Ventures moderating a chat with the founders of Vitude, a healthcare startup in Brazil, and RD Station. So join us on Friday, 1 p.m. They're going to be giving you a perspective on how this pandemic is impacting startups in Brazil. Thank you so much. Thank you, Hans and Andy. Obrigada.